once again, thank you all for joining us today. My name is Tyler May. I'm a partner and wealth manager here at Forest Asset Management. Joining me with host duties is our firm's principal, JoAnn May.
Hello, everyone. Thank you so much for joining us. And we really appreciate your time. And I think it's going to be a great hour. If you've heard Apollo before, you know why. So I'll let Ty keep going with the introductions.
Yeah, you guys aren't here for us. You're here for the main event. And joining us today is Vice President of Dimensional Fund Advisors, one of our favorite speakers, Apollo Lupescu. Dimensional is a premier global investment firm, and they manage about 1 trillion in assets right now for institutional investors as well as select clients of financial advisors. So if you're a client of ours, you're undoubtedly invested in some sort of dimensional fund. We love Apollo. And the reason we love Apollo is that he takes complex financial aspects and makes them easy to understand, relatable, but probably most impressively, he makes it entertaining. So without further ado, I would like to welcome Apollo to the webcast. Welcome, Apollo.
Well, hi, Tyler. Hi, JoAnn. Thank you so
Welcome.
much for the invitation to be back. And thanks to everybody who took the time to attend. It's actually such a treat for me because we've done this several times and I really enjoy our conversation. Thanks for inviting me back.
Absolutely. Well, we're thrilled to have you join us today and share your expertise with our clients. And we want to be respectful of your time. So with that, we'll just jump right in. And so we're a little bit more than halfway through the year, and it's certainly been an eventful one. Investors have had no shortage of headlines that are dominating the media, from the conflict in the Middle East to renewed inflation to leadership change at the Fed and rapid advances in artificial intelligence, AI. So if this were a football game, I would say we're heading into halftime. So as we look at the scoreboard, what does the first half tell us? And how have investors fared so far? And what are the key themes and opportunities you're watching as we head into the second half of the year?
Yeah, and it has actually been a crazy year. I can't really back in January we deposed a leader of a foreign country brought in the U.S. and that seems like a lifetime ago. So much has happened to your point. And towards the beginning of the year, particularly as we got into a war in the Middle East, it seemed there was a lot of anxiety and the markets did not really help because through the first quarter, the S&P 500 was down. The measure of the U.S. market was down about 4%. So as an investor through the end of March, you would have lost money in the U.S. market. And a lot of folks were anxious because there was so much that was happening, to your point. And what's fascinating is that when we did this about a year ago, if you look at the first quarter of 2025, what's really remarkable is that for the first quarter, the performance of the market was pretty much identical, negative 4.3% for Q1 of 2025, identical beginning. And back a year ago, we had the concern about tariffs and the economy and so forth. But what's interesting is that last year, we ended up having the second, the third, and the fourth quarter all positive. So by the end of the year, the S&P had a fantastic performance well above the historical average. It turns out that this year we're kind of seemingly following a similar pattern because second quarter was very positive in the U.S. stock market. So not only that we recovered the losses, but by mid-year, we were up about 10% as investors. So if you had started the year with $100 in your account, by mid-year, invest in the U.S. market, you would have $110, which is a great result in 6 months because the long-term average per year in the market is 10%, and we got that in half a year. So I think that's the first place to start. Is like there's a lot to celebrate. There was a lot of anxiety and concern as an investor in the U.S. market. Really did well for the first 6 months. Now, when we talk about the market, that's an aggregation, a combination of the performance of 500 different companies. And sometimes I get the questions, well, is there any one particular sector or something that did better that I should pay more attention to? And when you look at the S&P 500, this group of 500 stocks, and you are taking a bit of a deeper look, and you say, well, how many of these stocks went up in value versus down? Because certainly not every company went up or down in value. What you find is that about 62%, so about 300 out of 500 stocks, went up in value, and about 200 or so went down. So not every stock went up or down. And the question is there a pattern that would help you kind of identify what companies might go up versus down? And this is, again, it's a great lesson for investors if you look at the first 6 months of how unpredictable the market can be. And it's not about groups of stocks, but rather much more individual stocks. And what I mean by that, you take two large banks. You take Bank of America, Wells Fargo, very well-established, mature U.S. banks. Wells Fargo is in the negative category, Bank of America in the positive. You take Home Depot and Lowe's, Lowe's in the negative, Home Depot in the positive. Verizon and T-Mobile, Verizon in the positive, T-Mobile negative, and probably the ultimate example, Coke versus Pepsi. Coke was positive, Pepsi was negative. So, if you try to say what did well, it's really company by company, because seemingly very, very similar companies had different results. Some lost money, some made money. So it's not really productive to try to say, well, let me try to predict what's going to do well looking ahead. And you can actually go a little bit deeper and join and kind of go look not only at positive, negative, but by how much. And what's really fascinating in that respect is that if you look at the first 6 months, in the S&P 500, there were 94 stocks, 94 companies out of the 500 that had results between 10 and 20% up. So they went up in value 10 to 20%. 94 out of the 500 stocks in the S&P went up by that much. You have 80 companies, 80 stocks that went up between 0 and 10%. So those ranges of performance, 0 to 10 and 10 to 20, seem to be the most often. Now, the more you move to the extremes, and let's go to the extreme negative, you see fewer and fewer companies with extreme outcomes. In this case, there are 16 stocks in the S&P 500 that lost 40% or more of their value. That's an extreme negative outcome. You lose more than 40%. And once again, the question is, what are those companies? And some of them were software. If you look at Adobe, they make Photoshop, or Intuit, they make TurboTax, they lost value, but it wasn't just software. If you go through O'Hare, there is a machine there that you go through security made by a company called Leidos, and that was down over 40%. Accenture, the consulting company, down over 50%. Lululemon, the clothing company, down over 40% or so. So it wasn't limited to one group of stocks, but really it was kind of across the board, not really predictably to be known. But the good news is that if you go on the extreme on the positive side, we had 3 times as many stocks with extreme positive outcomes that went up over 40% in value. And it is interesting to look at what were those companies that did so well. And I got to tell you, what was the best performing stock over the first 6 months is a company that I've known from my days when I use an actual digital camera instead of the iPhone to take pictures. Because you had to pop a memory card. And a lot of my memory cards were made by this company called SanDisk. And SanDisk was the best performing stock for the first 6 months. So keep in mind, the stock market in the US, the S&P 500, was up 10%. I would invite you to guess how much did SanDisk go up in value when the market was up 10%. Well, it's a wild number. The SanDisk stock for the first 6 months was up 850%. 850%. It's just an amazing growth in this company. You had Intel, the chip maker, up over 270%. And it wasn't limited to just these tech semiconductor stocks. You had, for example, Moderna, the vaccine maker. It was up over 130%. DaVita, it's a dialysis center. My dad used to frequent that establishment, and that was up about 95%. You had Caterpillar, you had United Rentals. So again, it was a combination of companies that wasn't easily predictable. And the main lesson here, you're better off buying them all. You're absolutely better off buying them all than try to predict, what's the next DaVita center or what's the next SanDisk. Now, ultimately, from these 500 results, you just get to that one number, the 10.2%. And the way you get there is by analyzing not only the performance of each stock, but there's one other consideration. How big is that company? How big is that stock? Because the bigger it is, the more meaningful in the market. And the way we measure performance as investors, we assign a greater emphasis to the performance of the largest stocks. And the largest stocks, the largest 7 stocks, some of the largest stocks in the US market, they've gotten this nickname of the Magnificent Seven. And that's NVIDIA, Microsoft, Facebook, Amazon, Apple, Google, and Tesla. And what's interesting is that if you take these 7 stocks and you look at them separately, for the first quarter, when the market was down about 4%, they were down 11%, significantly more. They came back in the second quarter, and they were positive on average between the 7 of them. So by mid-year, what's interesting is that these Magnificent Seven were completely flat. So they didn't do much at all. Like, they were very flat, and they left a hole in the S&P. So if you look at the S&P 500 minus these 7, let's call it the S&P 493, that rest of the market did very, very well, did 15.6%. So very nice growth. So what is fascinating, JoAnn and Tyler, is that if you don't include these 7 stocks, the market would have been up 15.6%. You add 7 companies to the mix, and all of a sudden the performance goes from 15.6 to 10.2%. So what's going on here? How come these Magnificent Seven had such a huge impact on the US market? Well, the reason they had such a big impact is between the 7 of them, they amount to roughly about 32%, about a third of the value of the entire S&P, about a third of the performance of the S&P is driven by 7 stocks, which is quite a bit. And that's where you saw this very negative impact that they had on the market, because without them, it would have been tremendously higher results. And the same exact 7 stocks are also part of NASDAQ. But because NASDAQ doesn't include some larger stocks in the S&P, the percentage of these Mag 7 in NASDAQ is about 47%. So quite a bit, very, very concentrated into 7 stocks. Roughly half your performance in NASDAQ is driven by these Mag 7. And what's interesting is that the way that modern investors, and I know Forrest has this more comprehensive global approach, what's interesting about this, that you will not miss out on these Magnificent Seven. They will be part of a portfolio that includes not only the S&P stocks, but maybe smaller companies in the US, maybe international stocks. And at that point, your allocation to these Mag 7 will be roughly about 18% or something in that neighborhood. In other words, much smaller than the S&P or NASDAQ. And there's some really important lessons from here. Number one is when you look at the performance on your statement, it is likely not going to match NASDAQ or the S&P almost by design. Because if they wanted to match your NASDAQ performance, they would put half your money roughly into 7 companies, which I don't think is prudent. Secondly, when you invest, not just in the Magnificent Seven or the S&P, you get access to some other stocks. And for example, in the US market, you can split up the market and say, okay, the S&P stocks are these large, well-established, mature companies that we're familiar with, the Mag 7 plus Starbucks plus Boeing plus you name it. And they were up about 10.2%, and that was the performance for year to date through June. Now, smaller companies are also trading in the market, but they're not in the S&P 500. And that group of stocks, smaller company stocks, if you look at an index like the Russell Index, was up over 22%, more than twice as much. So there's a real benefit not to just limit yourself to large companies, because small company stocks in the US did fantastically well for half a year. And then we know that we can also split the large and small based on how expensive a company is, what's called value growth. So when you look at value, large value, for example, in the Russell Index was up about 16%, and small value was up about 23%. So what's interesting is that investors benefited this year not only from not being overly concentrated in these Mag 7 that didn't do very well, but you also got a benefit to the degree that Tyler and JoAnn and the team kind of emphasized small companies and value stocks. That really had a benefit this year. And the last thing to talk about is really a look at countries, because we talk about these investment companies as being a US. And even if you look at AI, one of the great stories is NVIDIA, and they make amazing chips. They design these chips, but the only company in the world that can manufacture their chips, the most advanced chips, is an investment in an emerging markets country, and that's called Taiwan Semiconductor Manufacturing Corporation. And in that factory, there's a machine that's almost science fiction in its precision, and only one company in the world makes that machine, and that's an investment in the Netherlands, and the company is called ASML. And the reason I bring this up is that, if you look at AI, so much is associated with the US, but there's seemingly a global value chain. And the obvious question, well, who holds the cards? Because it seems like an AI boom would benefit not only NVIDIA, but also benefit TSMC and SML. And you see that in the results of international markets. If you look at the US, when you include large and small, it was up about 11%. Comprehensively. Now, the ASML stock is a large part of the Dutch market, and the Dutch market was up more than 3 times as much as the US market. And the Taiwanese market, which about half of it is in TSMC, was up a whopping 61%. So clearly some benefits of being invested not only in the US, but also abroad. So really some interesting lessons, JoAnn and Tyler. Really fascinating lesson. Like the market wasn't driven by one sector. It wasn't an obvious way to define what did well versus not did well. Secondly, there was a great benefit to being more diversified outside of the Max 7, which made so much noise lately. And diversification in smaller companies paid off, value and international. And as a whole, some really fantastic results to report halfway through 2026.
Thank you for touching on that. As you said, JoAnn and I preach to our clients not only diversification through different countries, but also different asset classes. So it's been a great year for small cap, and our clients and investors around the world are seeing the benefits of having a diversified portfolio. You touched a little bit on AI, but I would like to focus more on the conflict going on right now in Iran, given how timely and significant this issue is for investors around the world. Apollo, how are markets processing and responding to the heightened level of uncertainty? One of my favorite dimensional phrases or slogans is tune out the noise.
Yeah.
But for investors who feel that the world today is fundamentally different, do the core principles of investing still hold true? And most importantly, what gives disciplined investors like yourself the confidence to look beyond the headlines, tune out the noise, and stay the course?
Yeah, and it's so important. And when you talked about tune out the noise, because before we get to the numbers and economics and investing, there's a real human element. And it is really hard to watch images of suffering. It is really hard to know that we are in a war again, and maybe friends or family are deployed in the Middle East. And morally, I mean, it feels like, okay, why are we doing this? So there are emotions that this event has triggered in all of us, which I think are absolutely legitimate, nothing to be ashamed of, because that's what makes us human. And that's where it gets interesting, because to me, tune out the noise doesn't mean ignoring those emotions. Again, you should pay attention because they're, and acknowledge them because they're real, and it's totally fine to have them. What it means is that you want to acknowledge them, and at the same time realize that successful investors can acknowledge the emotions and at the same time disentangle them from investment decisions. And whatever decisions they make about their money, they're not emotional based on how they feel, but something that takes account of data. It's something very pragmatic that looks at how the world actually works when it comes to investing, which quite often could be in conflict with our emotions. So what I mean by that? Well, the first thing to note is that when an event like this happens, what the market's trying to do, it's not assess its morality, but rather something much more fundamental. What is the impact of this event on an ability of a company to make money? Because ultimately, if you're going to buy ownership into a company, which is what the stock market allows you to do, you want to make sure that am I paying a fair price? So for example, if you want to buy an airline that had flights to the Middle East, operations got disrupted, and they're not going to make as much money. If you're an investor who wants to buy, well, with the war starting, they're not going to make as much money. That business is not as valuable. The market is assessing the impact, and it's changing the price of that company, the ownership of the company accordingly. And that's the function of the market, is not to assess morality, but the bottom line on companies' ability to make money. And not just for right now, but for years and years down the road. And the same event can have vastly different results for different companies. For example, if you're a defense contractor and you see this starting, well, maybe that's in a bad, not nefarious way, but maybe to you that's good news, because you're likely to get more orders for your missiles or defense systems, whatever you're building. So to me, that is interesting that the market is looking and assessing what's the bottom line. So what the market signal was the day after the conflict began is not that we ignored it, but the market barely changed the Monday after the weekend bombing of Tehran. And the reason for that is because the market looked and said a lot of American companies, like you look at Apple, I'm not sure how many iPhones Apple sells in Iran, but can be that many. I'm not sure how many Starbucks are in Tehran. So the assessment was like, well, there's a war there, but it's not really impacting the ability of most American companies to conduct business. Now, days later, you realize what the Iranian strategy is going to be with the Strait of Hormuz, and everybody became a geography expert. And then you realize, well, there will be an impact, and that got reflected in the market. And so it is important that it's not about the morality, it's about the earnings. And the second thing to know, Tyler, is that when you look at this is one event. At exactly the same time when the war was going on, there's another event, and we touched on it, which is AI. And AI is very likely to have a positive impact on of a company's ability to make money down the road. So then you counterbalance. In the short run, maybe there is this war that's generating headlines and is generating anxiety, and perhaps in the short run there will be some less ability to make money. On the other hand, you look at AI, and years down the road, it's going to have a positive impact on a business. And all these variables come into play. And it's really hard to disentangle and say this is exactly the impact of the war versus AI versus whatever else might be the case. Their strategy, how they execute. So the first thing to know is it's a little more complicated than just say, oh, there's a war, it's bad. There are other factors at play that are much more bottom line oriented. The second thing to note is that when a company is faced with challenges, and a country for that matter, what we always see is that they don't fold a tent. They don't just say, oh, there's a challenge, let's close the doors. Like when the pandemic happened, look at all we did. We started using Zoom, and you couldn't get a margarita in a restaurant, take it home in a cup, and hopefully don't drink it dry. But it's the idea is that companies, when presented with challenges, they innovate. That's when human ingenuity comes along, and then they get creative. And we see this over and over and over again. So in the short run, there's a challenge. That's the point. But once you get past the challenge, what we always see is that invariable companies and even the economy, the country actually gets stronger. What emerges is a stronger country, a stronger economy. And probably to me, the two examples that I'll kind of toss out quickly, the first one is the energy crisis in 73, 74, when we're so dependent on oil from the Middle East. And because at that point, OPEC decided to stop sending oil to the US, we had a huge energy crisis. And imagine that you're sitting in the back of this car, and Tyler and JoAnn, you're probably too young to remember that. I was talking to my older family, and they were like, "Yeah, we're in that car," and it just felt like the world is different, that we're doomed, that we're done, there's nothing we can do. And it was scary, and I have no idea, but there was a big challenge that we had to deal with as a country. But what emerged after that was, hey, you know what? We cannot be as dependent on foreign oil. And today we are a net exporter of oil. We don't depend on foreign oil at all. We made these gas guzzlers. Hey, maybe we need to have more fuel efficient cars. So to me, the pandemic is another example. What we had was supply chains that were not as robust. So we reinvented them. These companies reinvented them, and now they're stronger. So I have no doubt that whatever challenge it feels right now, at the back end of it, we're going to come out stronger, whether companies or the country as a whole. So yes, it feels different for sure, Tyler. It feels different. I just think it's different pretty much in the sense of remember the pandemic, speaking of the pandemic, there was a show called A Queen's Gambit or The Queen's Gambit. You remember that show? It was a chess game.
The chess? Yeah.
Yeah. So I started watching it and I start playing some chess. And I'm not good, but I keep playing. And what's interesting is that in all the games that I played, I never end up in exactly the same situation. It's never the same position. It's always different. Always different. So what's been interesting to think about is sort of like, could this be that this situation is pretty much like in chess, that this situation is different, but in chess there is a fundamental premise that stays the same. You got a chessboard, there are 16 pieces on each side and 64 squares. So could there be like a chessboard of investing that is the same, even as the situation is different? And to me, that is the chessboard of investing. What I just talked about is the fact that companies that operate in free markets, they will find a way to navigate what's put in front of them. We see this over and over, and ultimately, what comes out of at the other end is, in fact, a stronger country, a stronger company. And probably the other ultimate example is you look at World War II, when all these car companies did not have customers because all the soldiers are fighting in the front. And if you're Cadillac, what do? What they did is they put the engine into a tank and they sold it to the government, and that's how they made it through. Ford made airplanes. Disney, they were making war commercials. Coca-Cola basically got started in the global business because they talked Eisenhower into opening bottling plants around the world to serve soldiers Coke. And when the war was over, they had all these bottling plants around the world, and that's why Coke is a global company. So again, it's the idea that in free markets you will have companies innovating, and it's the resilience and the ingenuity that gives me the confidence going forward, Tyler, ultimately.
To throw out another dimensional slogan, markets work, right?
Markets work. Yeah. I mean, that's what you're buying into. You're buying into the human ingenuity. You're buying into the resilience of people, and the fact that in free markets, there will be innovation, that people will figure out how do I make this work?
Completely makes sense. Definitely. Innovate or die, basically.
Exactly. And we see this over and over. And the key requirement there is operating free markets. Like don't have a situation like North Korea or Cuba when the government tells you what to do. That's why I wouldn't be as confident in those countries.
Right. Exactly. No. All right. Well, that was a great explanation, and I'd like to switch gears a little bit to a topic that I have been getting was getting a lot of questions on, and I'm sure I'll get more as more companies come to their initial public offering dates. So we've had a big year in 2026 with IPOs. Of course, we've had soon to have Anthropic, OpenAI, and the big one that a lot of people were asking about was SpaceX. So, it was a big debut for Elon Musk, and it went fairly well. And like, as I mentioned, I did get quite a bit of questions on it. So while individual stocks are not what we generally comment on or even watch per se, it still raises an important question. What role does things like IPOs have in an investor's portfolio? And does it change anything about the future, about disciplined long-term investing? How do you feel about that?
Yeah, it's absolutely, it's worth touching on. And you mentioned Elon Musk, and what is interesting, JoAnn, is that he tends to be a polarizing figure. And I've been to enough events across the country, and some folks who say I need to run and go buy a Tesla because of Elon. Other people will never even take a look at a Tesla because of Elon. So it's a polarizing figure that has a following, and to me, like, rather than debate, whether his politics or whatever are good or bad, I think that I would like to celebrate, in a way, something that is really important, which is entrepreneurship. And here's an individual who, over the course of about 2 decades, about the same time that I've been in dimensional, was able to build not one, but 2 companies. So that entrepreneurial spirit and thinking big is something to be celebrated. And along with that, the system that allowed it to happen, the capital markets that allowed these 2 companies to grow to this size, which is something that I don't believe could have happened in any other country, only here. So that's something to celebrate. Now, when it comes to specifically the IPO, let's kind of go back because, JoAnn, if it's okay, I want to demystify a little bit. What does it mean, an IPO? What's an IPO? How does it actually work? Because there's some really important considerations for investors from there. And what basically happens is that a company like forest asset, like dimensional, like SpaceX, starts by an individual having an idea, and they set shop and they build a business, and that business is private. It belongs to that individual. Now, as they look to grow, perhaps they bring in other investors and they say, listen, if you want to give me some of your money, we can grow the firm and you can partake into the ownership of this business as it grows. And that's what Elon did. He brought in other investors, but the company was still private. He controlled who the other owners would be, who would be allowed to invest in his company. It was something that he controlled himself, and he could handpick. Not only that he had to like SpaceX, but SpaceX had to like you back. And that was the case for many years when the company was private. And it reached a point for a variety of reasons. One of the reasons that they need to raise more money, or the other one is that some of the original shareholders in that private company wanted to cash out. Whatever the reason might have been, SpaceX and Elon Musk, they decide they want to go public. So what it means to go public is that at that point, the ownership of SpaceX is open to everybody in the society. Anybody can purchase ownership in SpaceX. And at that point, it becomes a publicly listed company. So the owners no longer have a say who controls who owns or not. Anybody in society can own a piece of SpaceX. And that is the process from going private to being public. And that's what IPO is, initial public offering. And when that happens, it turns out that the company itself can decide a very important element. How many of those private shares will we release to the public? And that is called, in technical jargon, free float. What percentage of the shares are available to the public? And what we saw is that when SpaceX became a public company, what they decided to do is offer only 4.2% of all the shares of ownership to the public. Only 4%. So a very limited supply, and it's not really unusual to have a more limited supply as the company gets going. In fact, the average IPO is limited. It's not as limited, but it's still 34%. That's on an average IPO. 34, about a third of the shares are available for trade when the company goes public. In SpaceX case, it was a sliver of that. It was a sliver of that. So what happens to the other ones? Well, the other ones, it turns out, are basically shares that are in a period called a lockup period. And what it means is that different owners of those shares have different terms, in different time periods when they can start selling the shares that they own. So the lockup can expire in a month after the company went public, or 3 months, or 6 months. In some cases, it depends on company metrics. But the bottom line is that when SpaceX went public, what they did is they severely limited the supply of shares available. So think of a big block of cheese. They cut a little slice, they dangle it in front of all the Musks, they toss it out there and just say, hey, go for the feeding frenzy. So obviously there's a huge demand because of all these folks who are following SpaceX, and there's a huge demand, and you know, that's kind of what happened. But the reality is that it's a very limited supply. Now, as lockups expire, if you look, for example, at companies in the U.S. market, the more time you give, after 6 months, it's about 53% of shares, because lockups expire and those shareholders sell. About a year later, it's 58%. And once the companies are basically mature in the market, roughly about 96% of all the shares are available for trade. So to me, the first thing to consider, if you want to own a piece of SpaceX, well, when exactly do you want to own it? Because if you're going to buy right now, it's 4.2% of shares being available. If you are patient enough to wait till the end of September, you find that 5 times as many shares will be available. So the supply would tremendously increase. So this is, you know, Econ 101, supply and demand. If you're going to have sort of the same demand and a huge increase in supply, what can possibly happen. And the more time you give, more of these shares will come out of lockup. So by next year, about a year from now, by the end of the year, it'll be 40%, 10 times as much. And then by the end of June next year, will be 12 times at about half the company. So it is interesting. The first question that you want to ask yourself is that, do I want to jump right now and go buy SpaceX? You could, again, if you look at the basic supply and demand, it's a very limited supply. And it was almost on purpose that they did that, in my opinion. You never know. Nobody ever knows for sure. But it's, if you're smart, you limit supply. You see there is a big demand. You limit supply, price is going to go up. Now, as more supply becomes available, it's everybody's guess what's going to happen to the price. But to me, really smart investors have some flexibility. So they don't jump in there, I need to get it today. The second thing to consider is when you buy a company is, well, what exactly am I buying in that company? And in this case, as I said, entrepreneurship set up just a very ambitious goal for SpaceX. And JoAnn, if you don't mind, I'm going to read sort of the first sentence in a filing that SpaceX had to provide investors. It's called an S-1 form that is available on the SEC website, Securities and Exchange Commission's website. And basically, it's the very first sentence in the document spelling out their mission. And what it says, our mission, it says, is to build the systems and technologies necessary to make life multiplanetary, to understand the true nature of the universe, and to extend the light of consciousness to the stars. That's what you're buying into. It's a very ambitious project. My guess is that if your neighbor came and told you, hey, why don't you give me your money because I want to build a company with this mission, you'd be like, okay, but this is Elon Musk. So people are, well, he can do it. And that's possible. And you're buying into that dream, but it's a very big dream. And what the monetization of this dream is, like, yeah, I mean, we barely have a few astronauts on a space station, but we're not going to sell just to the humans on Earth. We're going to sell them all over the planet. So it's a very ambitious project, in other words. And you have to be aware that you understand what you're buying into. And that's really important. And the way that investors have done this traditionally is by looking at valuations and say, okay, if I want to buy into this, what am I getting? And in this case, they don't really make money. So because they don't make money, they actually lost billions last year. Another way to evaluate how expensive or how good of a deal it is to look and say, okay, fundamentally, every company has some assets like buildings or whatever, in this case, rockets. And those maybe have some loans. So if you look at what those assets are worth, after you pay out all the loans, all the liabilities, you get a metric that reflects what's the value of those assets. What is it that we owe after what we own after we pay everything that's owed? And that's what's called book value, the value of all the assets after liabilities are paid. And you can say, well, how much would it cost me to buy, let's say, $1 billion in those assets? In the US market, that number is about 2.7. So to buy 1 billion in assets, you need to spend about 2.7 billion for the stocks in the US stock market. Now, companies, as they go public, they tend to be more expensive. The typical IPO on average has about 6 as that ratio. And what's fascinating about SpaceX is it's magnitude higher. It's 21.7. Wow. It's magnitude higher. So it's a very expensive proposition compared to the market and all the other IPOs. So you have to kind of figure out, well, is this a good deal? Because I'm paying through the nose for multiplanetary life. It's possible. You just have to be aware that like it's a very big proposition. So what's ultimately the punchline with SpaceX? I cannot tell you it's a good investment or a bad investment, but what you can consider as an investor, number one, is when do you want to buy it? Do you want to run and get it today when the supply is limited, or can you be patient enough and wait for the supply to increase? You tell me what makes more sense to you. Number two is that, what is the valuation? In other words, how much are you paying? Because that's going to be really important to know in what strategy you might want to put this company. Value strategies that have a relatively low price, that probably is not going to be a fit, maybe in some other strategies. So you have to look at valuations to figure out in what strategy. And thirdly, you have to decide how much I buy. And the amount that you want to buy, it really depends on how many shares are available for public trading. And when when SpaceX went up, when the public, even though the number that was publicized, the $2 trillion in value, the reality is that what was available was a very tiny sliver. And because of that sliver, if you look at the US market, the percentage that you would have allocated to SpaceX would have been in the neighborhood of like 0.1% or something like that, a very, very tiny fraction. It wouldn't have been a lot because such a tiny sliver is there. So those are the three considerations. Basically, when do you want to buy it, in what strategy it fits, and then how much do you want to buy of it? And our sense is that as an investor, you are better off having a manager who can analyze this and have some flexibility. And one of the things that we've seen with this SpaceX IPO was the fact that indexes, which are lists of stocks provided by different committees, have had a really interesting time negotiating SpaceX. In some cases, S&P decided we're not going to add it. In other cases, NASDAQ decided we're going to change our rules so we can add SpaceX. In other cases, so it's all over the place. And these committees make a decision. And if you're an investment manager who licenses their list to create an index fund, you are forced to buy or not buy based on what the decision of the committee was. And we kind of find this is just a remarkable illustration of how these indices that you're buying, they're not really clean cut. Like, you're better off with a manager who can control their own destiny rather than being told by a committee what to do. And I think that's kind of been, at least from my perspective, really interesting benefit of this more systematic, flexible approach like Dimensional has, to kind of control your own destiny, not just follow blindly what a committee tells you to do.
Apollo, that was really interesting. And you beat me to my follow-up question was about the indexes. So you've already covered that, but can you go into more detail on how Dimensional handles IPOs
Yeah,
and
so
how they
we've
have
been,
and how they have for
yeah.
years, right?
Yeah, we have for years. So basically, it's all based on research that was done, not just at Dimensional, but pretty much the academic community. There's a professor at Florida, Jay Ritter, who has been publishing for many, many years, and so it's a very interesting area because what we see typically, and it's multiple reasons, but to me, I cannot imagine that it's not to some degree tied into the idea of lockup periods. That you have this period until these existing shareholders can sell and the supply stabilizes, that you're probably better off waiting, because the more supply increases, unless the demand doesn't skyrocket as well, you're going to see a price perhaps leveling off. And what we see when we look at IPOs 1 year after launch, they are positive. They, on average, a stock that went public 1 year later would go up in value about 5.6%. So you're not going to necessarily lose money on that. On the other hand, if you look at the market over the same period, it's at least twice as much. So you are giving up some potential upside. And our view is that the way that we've approached IPOs over the years is that there is no real rush to go out there and buy day one. Why don't you wait until these lockout periods expire, be patient and flexible, and ultimately, at some point, you want to add it. But remember that because of these lockups, even if you wanted to add it, the percentage would be so small that it wouldn't make a huge difference. So what we've tried to do is really be very patient, very clever about this. And typically, we don't really buy an IPO in the first year, but we have the flexibility. You look at the IPO, you look at what percentage of the lockups expired. So you have that under your control. So that's kind of how we've done it historically. Be patient, no need to rush and get it day one. It's going to be a small percentage, and then figure out exactly in what strategy would fit based on its valuation.
Well, that was awesome. It was funny. I loved your comment earlier about the unrest, or excuse me, the conflict in Iran created a lot of geography experts. When SpaceX IPO'd, I was having a lot of family members, I shouldn't say a lot, of few and more buddies reach out that suddenly became financial experts. So I love that comment and the control your own destiny portion. But so we're kind of nearing the end here, and a client actually reached out ahead of time. And it's a question about the new chairman of the Fed. So Kevin Warsh succeeded Jerome Powell, and at this moment, there's renewed inflationary pressure, as well as the backdrop of comments from the president and his administration with a desire to influence interest rate decisions.
Yep.
I was wondering if there is any historical context or precedent when such interference happened in the past. And what does the current environment suggest about the direction of rates?
Yeah. So what's fascinating is that if you go back to the inception of the Fed and why do we even have a Fed? What's the background behind it? It was in the early 1900s when we had bank crisis, and the way they got solved. Funny enough, it was J.P. Morgan pretty much asking all the heads of banks to come to his office. He would lock them up, and he said, "Guys," and they're pretty much all guys at the time, "you are not getting out until you sort this out and figure it out." And that's how bank crisis got solved. And there was a realization that this guy is not going to live forever. So the idea was we need to institute a body in the country, an organization to oversee these banks. So what happened was in 1913, we had this Federal Reserve Act that introduced the idea of the Federal Reserve. And in the beginning, the idea is let's regulate banks. And the Secretary of the Treasury was involved. So the policies of the Fed were also impacted by the administration. And that's when, not to be politically influenced. So what they did in 1935, they introduced the Banking Act, and that is, in fact, the law, the act that still governs and it's still the foundation of the Fed today. And that is a very clever law because what they did is they said, okay, so this Federal Reserve, we're not going to have it run by the Treasury or anybody else, but rather the president can appoint a number of governors. And there will be a board of 7 governors, and they will be appointed by the president, and there'll be long enough terms where multiple presidents might be represented on that board. And only one of them will be the chairman. So the Fed chairman is just one of the 7 board members. And on top of that, there will be 12 different regional banks, which they all have a president. And by rotation, 5 of them will join the 7 governors, and the 12 will become something called the Federal Open Market Committee. And these 12 individuals will vote on the policies of the Fed. So what I think is so interesting is that when you look at this, it is not the Fed chairman. The Fed chairman is one voice, but there are 11 other votes. These 5 folks from regional banks have nothing to do with the president. And the rest of the governors, they are grown-ups with a mind of their own, and they have their own opinions. So it's not, the system was built not to rely on an individual. You got 11, and some of these board governors were appointed by the presidents. So it is something that has a built-in resilience and some checks and balances. And that's still the case today. During the war, it turns out that not long after we had the war, the Treasury did actually coordinate with the Fed to maintain low rates so we can get through the war. So the country wouldn't pay a huge bill on interest. But because that was not necessarily sustainable to have this coordination, in 1951, there was a landmark memo that the Treasury put out saying that as of today, we are completely out of the business of interfering with the Fed. And that was a landmark accord. And the Fed chairman at the time was a gentleman named McChesney Martin. And it turns out that not long after, he was still Fed chairman when Lyndon Johnson approached him and wanted him to argue and kind of help him lower rates. And McChesney Martin basically stood his ground, where apparently he got called at LBJ's farm in Texas and apparently got pinned against the wall, and he still didn't give in. He was like, no, we're going to be independent and I'm not going to give in to your pressure. And he did not give in. Now, in 1970s, in 72, a new chairman came along, Burns, and he was apparently more influenced by Nixon. There was a situation where the perception was that Nixon was influencing Burns. And maybe the decisions were more influenced by the politics. And what resulted was a decade of very high inflation and very bad economic output. And the good news that in 1979, a new Fed chairman came along by the name of Paul Volcker, and he basically said, no more monkeying around. We need to reestablish the independence of the Fed. And he basically fought really hard to make the Fed independent again. And that's what he did. And for many, many years afterwards, we had that situation until more recently, to your point, where there was an attempt by the president to have a greater say. So what's the punchline of all this? Well, the punchline of all this is that the system itself is built with a level of resilience, and it's not as dependent on one person as most like to believe. And secondly, we have seen situations in the past when a president didn't try to influence the Fed decisions, and in some cases it worked with Burns. In other cases, with Chairman Powell or McChesney Martin, it didn't. And the idea that it's unprecedented, we've never seen before. Take a history look. Take a look at history, and you do see that there were cases, and it's not as easy. It's not as simple as some wanted to make it. Now, the Fed today has not only the mandate to regulate banks, but we gave in '79 it was given two more mandates. One, we want the Fed policies to maintain stable prices. And secondly, to make sure the economy is humming along. And sometimes these two objectives can be in conflict with each other. And that's what the Fed has to manage. And what the new chairman said is, like, to me, between the two of them, it seems that inflation carries a greater priority. So that's the message. And what it means is that if the Fed chairman, for example, sees inflation going up, if you lower interest rates, you're sending a signal that I want businesses and consumers to spend more, and that might push inflation even higher. So that's not necessarily a good thing. If you increase rates, you slow down spending, but you also might hurt the economy. So for the course of the first 6 months, what the Fed has done is not change anything. Just kind of be on a hold pattern and just say, we're not going to change anything. The federal funds rate that they control is going to be pretty much flat, so not much to see there. Now it turns out that the Fed controls these rates that tend to be very short-term in nature, but not necessarily the longer-term rates. Because when you look, for example, at 10-year interest rates, they're not controlled by the Fed. The Fed did not. The Fed did not actually make any moves, and this interest rate went up by about 0.7% by itself. So what's driving this? A big driver of the long-term rates, not the only factor, it's the expected inflation. If I'm going to lend you money for the next 10 years, I want to at least be able to buy the same things that I can buy today. So the bogey there is basically inflation, expected inflation looking ahead. And when the war started, the issue was that not only that we paid more at the pump and the groceries might get more expensive, but investors wanted a compensation for the expected inflation that this war might generate. So interest rates went up. And the reason that this is so interesting is that they did not move because of the Fed. And these long-term rates are more meaningful to a lot of people than you think, because if you look at the history of the 10-year interest rate in the US and you overlay the mortgage rate, it becomes really apparent that the two of them are related. And that's what's so interesting is that when inflation came, the result of that is that the Fed was put in a bind. Like, I can't really lower rates right now because I'm sending a signal that I want businesses and individuals to spend more. And that's not a good idea because you'll fuel inflation and the perception that the Fed is under the influence of the president. On the other hand, if I increase rates, that's not good either. So they kept them flat, which is likely what's going to happen if nothing changes. If you see inflation go up, you might actually see an increase in rates. But it all depends on what inflation does, because that is seemingly the priority among the two mandates. But I do want to go through this whole exercise because there are 2 points to be made. One is that the system is built with checks and balances where not everything resides on what the Fed chairman says. He's one of the 12 voices, or the 11 others. And number 2 is that when you look at the interest rates in the economy, some of them are controlled by the Fed, these very short-term rates that impact your CD, certificate of deposit at the bank, and maybe overnight loans. But the longer-term rates are not driven by the Fed. They have nothing to do with the Fed. They have much more to do with expected inflation, how much the government needs to borrow, other things, and that's again outside of the control of the Fed.
Well, it looks like we are approaching the hour, but I wanted just to get in one more quick question,
Yeah,
hopefully quick.
quick.
I have a question from a attendee, and it is about prediction markets. And
Yes.
first of all, maybe we should define what they are, and
Yeah.
then do you think they will have any impact on market fundamentals?
So prediction markets are a relatively new phenomenon as being in widely available in society. Prediction markets basically were got started decades ago, and they were funded by the Defense Department. There is a group called DARPA, and the Defense Department basically said, well, how can we actually get information about possibly who might get assassinated or deposed in a particular country? And they said, well, if somebody has that information, if there's a venue where they can predict the market prices in that auction, will let us know what to expect. And after a bunch of time, they basically canceled that. There were some other forms that kind of came along at Iowa. You can predict the outcome of the election, but it never really took off. But more recently, a new breed of prediction markets came along. And the prediction markets are basically websites that are set up when anybody can create a contract. And the contract is basically saying, okay, what's the chance that Jeff Bezos will be at the Super Bowl? And there was actually a contract exactly on that. Will he be at the Super Bowl or not? And people bet on it. And you can bet and say he will be and he won't be. So you can see the odds and how much are you paying. And when that event happened, it's a 0-1 situation. Either it is there or it's not. So it's really predictions are equal bets. So you're just placing a bet. And right now, if you look at these prediction markets, there's so many bets that you can place on, not just soccer games or every single thing. Well, and right now the impact on the market is rather minimal because we have seen that there, just not enough money to move, and the predictions that are most catching on don't really have to do with the market. The original way of prediction for the market, if you wanted to bet on the market, is a different way called options. And options basically you buy the right, but not the obligation to get a stock at a predetermined price. So basically, you think the stock is going to go up, you can pay $2 today and pay $10 for that stock, and then you agree today. And if the stock goes to 15, great, because then somebody has to sell it to you for 10, and you cash out that difference. So believe that these prediction markets like Kalshi and others are really impacting the market as much because there's such a wide array of bets, anything you can think of, and it's just the scale is not, the volume is not high enough to get even close to what is actually traded in the market. So because of that, I think it's just a betting platform. If you want to bet, that's a place to do it. You don't need to go to Vegas anymore. But I don't believe that it's really impacting the markets at the moment.
Okay, I'm glad you said that.
I mean, there are attempts to influence. To be honest, there are attempts to influence, but not necessarily the market as a whole. Like somebody had a bet on what's the temperature going to be at the Paris airport, and somebody did go there and try to tamper with a thermometer because they would win the bet. So yes, there are attempts to tamper, but it's more in that vein rather than go in the market. The market is so big and so well regulated that it's harder to influence that. It's easier to influence a thermometer at an airport than trading of NVIDIA.
Got it. Well, this has been an amazing hour, and we really appreciate your time today. And I hope the clients, I'm sure, got a lot out of it. Ty, do you want to add anything?
Yeah, thank you very much, Apollo. We learn something new every single time we speak. So I'm
Great
sure
fun.
all of the attendees share that sentiment. And for the attendees, I think we got clients and prospective clients in here. A replay link will be available in a week. So if you have someone in your life that would probably find this interesting, feel free to share it. Apollo, thank you again for your time and expertise. We will see you in a week.
I can't wait. Thank you so much to everyone who attended. Bye-bye.
All right, bye-bye.